Hi, I'm Eric Weisbrod from the University of Kansas, and this video is joint work with my colleague Jim Ohlson. Today I'm going to be talking to you about using accruals and free cash flows to forecast earnings in the context of equity valuation. Now, if you just found this video on YouTube, I'd like to point out that this is actually the 5th video in a series that we've put together on equity valuation. So if you haven't caught some of the prior videos, you might want to stop, look at the notes below the video, and find the links to the earlier ones and work your way up to this video. As a recap, or if you're just tuning in, this series is designed with, say, a beginning investment banking analyst or perhaps a first-year PhD student in mind. So someone who has a little bit of background in business concepts, maybe looking at data a little bit, but still wants to gain a deeper understanding of equity valuation. And this covers some introduction. In some sense, we jump right in. So the first couple of videos are a brief overview of the core principles, as well as in the second video, we get you as quickly as possible to a working valuation model using earnings, book values, and dividends to value a stock. And then we step back and we work through some of the underlying theory and concepts underlying valuation. Now, instead of being like a big textbook, we're trying to put these into layman's terms, really focus on the core message here, and try to bring the key concepts to the forefront that you might not get in, say, a corporate finance textbook, especially coming from, I'm an accounting professor, so this is sort of the accounting take, or what accounting brings to the table in terms of understanding equity valuation. But it's the same principles that you'll see in classic finance or economics. And so starting with the third video, we go back to the beginning. If you think of a stock as representing the present value of expected dividends, then you can dig into the classic concept of dividend policy irrelevance, where it doesn't matter whether we pay the dividends right now or in the future, as long as the company is generating the earning potential to pay out those dividends eventually and growing at an appropriate rate. In order to figure that out, we learn how to reformulate the financial statements between operating and financial activities. And that was the first video where I stepped in as an instructor. So if you go back, you can watch my initial video. I gave a little bit of my background. So I did work for a couple of years before getting back into academia, but the last several years I have been in an academic setting, and I've focused on these concepts in teaching financial statement analysis, doing my research, and I've even found that some of the accounting and finance PhDs that I've been mentoring in recent years, these concepts that we're covering here keep coming up. And so once we learn how to reclassify the financial statements into operating and financial activities, that also allows us to decompose earnings into its accrual and free cash flow components. And so then we talked a little bit about what you want to use to value the firm and what's the role of free cash flows. But the main idea is that the value is really generated by the firm's operations, its main line of business, and the financial activities, which make up the free cash flows, are really there either to raise money to fund the business or distribute the proceeds from the operations. And so today we're going to go a little deeper on that and show you how to use accruals and free cash flows in a forecasting context. So before I dig into our two main research questions here, I want to actually start at the bottom of the slide, which is a recap from the last lecture. And so in the last lecture, we showed you that operating income can be decomposed into the change in net assets, which, if you look at the first line, can be even further decomposed into the net of operating assets and operating liabilities. So when we say NOA, or net operating assets, we're saying the operating assets net of the associated liabilities. And so what we're going to talk about today is that in some cases it does make sense to net those two things together, while in other cases we may want to look at each of those components individually. Now, once we net the two types of accruals together, the assets and liabilities, then we just have two components of earnings. We can think of the change in net operating assets as the net accrual, and the other component is FCF, or free cash flows. So when we're thinking about the net accrual, we're going to look at how we can use both parts of the accrual, the assets and the liabilities, to forecast future sales, future expenses, changes in earnings. And then when we get to free cash flows, we're going to dig into this notion that there's this cliche that cash is king, or what investors really care about is free cash flows. Show me the money. But we're going to talk about whether that adage really holds or not. And we started getting into this last time. It turns out that negative free cash flows are not necessarily a bad thing. They could just be implying that we need to raise money to grow the firm's operations. And we'll see what implications that have for using free cash flows as a forecasting or performance metric. Okay, so let's start out with this concept of operating asset and operating liability accruals and what they might tell us about growth in the company. So starting with operating assets, let's visualize some common examples of operating assets. So the easiest one might be to think about inventory. So when we're growing our operating assets, that means we're building up inventory in the warehouse, or perhaps we've opened a new factory, or it could be that our accounts receivable are growing, things like that. Usually, I would say the most common case is that this is just a sign of a growing business. So if we're ramping up our inventory, it's because we expect to make more sales in the next period. Now, you always have to check into these things individually. On the one hand, it could be that we're ramping up to sell more. On the other hand, it could be that our inventory is not moving off of the shelves and we haven't adjusted our production accordingly. And so, again, I'm going to give you sort of the general takeaways, or the most common cases, but you as an analyst want to dig in individually. That's a good lead into our next point about operating accruals. And that's, the normal case is that they represent an investment towards future growth, but since these by definition are sort of non-cash amounts, they also involve estimates. So another operating accrual might be something like goodwill. What if my balance sheet is growing because I completed a merger and acquisition and then I added a bunch of goodwill to the balance sheet? Well, that goodwill is, sort of an estimate based upon the price I paid in the acquisition, and it's not at all clear that I really got all the value I paid for, and that really is going to result in all the synergies and everything I'm hoping from the acquisition. And so you might have heard this common notion that we need to be skeptical of accruals, and this is just an accounting entry, and if it's not backed up by cash, I don't know if it's going to materialize. So I think, again, I would start with number one. The main concept should just be this: I'm building up my inventory for future sales. This is an investment that will lead to growth. That would be my first assumption when I see an operating accrual. But we want to keep in mind that you could have some aggressive estimation. You could have some aggressive accruals that are not going to materialize in the future, and we need to keep an eye out for that. The third concept that we want to think about in terms of our operating assets and liabilities is that in some ways they're just like financial assets. So a financial asset is something like cash or a bank loan. And so for both assets and liabilities, we can also set aside their implications for our operations and also just think of them from a liquidity perspective. So if we see accounts receivable, that might be something that we could factor our accounts receivable, sell them to a third party and collect cash. If we see accounts payable, yes, it might have implications for our operations, but also at the end of the day, that's a loan. So even if it's a loan from our suppliers, it can be viewed similar to a bank loan, and we need to take it into account when we're thinking about the company's solvency. Let's go through from the top our operating liabilities. Now, the key point here is that even though something like accounts payable, it does represent a loan from our suppliers, that's not necessarily a bad thing when we're thinking specifically about growth. So taking out a loan from our suppliers in order to build our inventory, again, when do we most likely do that? We do it when we're planning to make sales in the future. Okay, we're saying, I feel confident that I'm going to be able to sell this inventory, and so let me produce it on account from my suppliers, and then because I'll be able to sell the inventory for a profit, I'm going to use that money to pay them back. So the same way that a buildup in the asset can point to future growth, a buildup in the liability can point to future growth in the same way. One more example would be something like deferred revenue. Deferred revenue technically is an obligation that I need to deliver a product to a customer. But you could also think about it as this is a growing backlog of pre-orders for my product. Not only do people want my product, they're willing to prepay me for the product, and I have a waiting list. That could be an absolutely amazing sign for future growth in the sales of the company. So we don't want to treat that as a negative when predicting future sales. We want to treat it as something that predicts more future sales, the same way that a buildup in inventory would predict more future sales. This example of deferred revenue, that can lead us to point number 2, that if we see growth in operating liabilities, it could be because we're just being conservative in our earnings. So that deferred revenue is a great example of accounting conservatism. We've actually already collected cash from our customer for an order. We just haven't been able to recognize that revenue yet because of accounting conservatism. Accounting conservatism says you can't recognize the revenue on that sale until you actually deliver the product to the customer. And then I already talked about the fact that operating liabilities at the end of the day are in many cases a loan, just like a bank loan or financial liability. Okay, so we've created this table as a visual summary of the key takeaways that I just talked through. And I think the main focus of this table is here in these cells. We see that both operating assets and operating liabilities signal increases in expected future sales. So the same way that a ramp up in inventory is a signal that there's going to be growth in future sales, a ramp up in accounts payable or deferred revenue also signals an increase in future sales. On the other hand, the implications in terms of accounting conservatism and the cash or liquidity perspective of these does differ. So with respect to accounting conservatism, if we've been too aggressive in our asset accruals, then this value is not going to materialize and we're actually going to see reversals in future periods. On the other hand, if we've been overly conservative, going again to that case of deferred revenue, then as soon as we deliver that product to the customer, we're going to see this liability reverse, and that's actually going to generate more sales in the future. So accounting conservatism works differently for assets versus liabilities, and this will become important again once we get to the earnings forecasting part of the lecture. And then finally, when we think of these in terms of claims to cash, by definition, an asset is a claim to a future benefit that's going to result in cash inflows, whereas a liability is by definition an obligation that signals we're going to have to spend something to satisfy that obligation. The same way that financial and assets and liabilities also represent either claims to cash that we can receive or obligations to pay cash. The key thing with respect to financial assets and liabilities is that unlike operating assets and liabilities, they don't have implications for future of the operations, right? They don't signal excess growth. They're generally accounted for at fair value, and there's not a lot of accounting aggression or conservatism in the way they're presented on the balance sheet. Now let's look at some data to solidify these concepts that we just talked through. If you really boil down all the points I just made, the question we're trying to answer is, if you see the balance sheet growing, does that also lead to growth in the income statement? We often think about growth in sales. We predict sales growth when we're doing a forecast or building a valuation model. But really, when companies grow, the entire company grows. So again, if we see growth on the balance sheet, that might forecast both growth in sales and growth in expenses. Both sides of the income statement might be growing. In other words, you have to spend money to make money. And so usually expenses and sales are going to grow, along the same lines. And so we did a very basic data exercise to see, again, if your balance sheet grows this period, whether it's a growth in operating assets or a growth in operating liabilities, what's going to happen to your sales next period? So we took all of the companies in the S&P 1500 and we made a very simple 2x2 table. For example, we could look at Apple in 2010 and say, starting from the first table, during 2010, did Apple's operating assets increase or decrease? If so, what happened to Apple's sales in 2011? Did their sales increase or decrease? And again, we did this for all of the companies in the S&P 1500 over a period of 20 years. The first thing to notice in this first table is that most companies have positive sales growth. So that's a basic feature of business, is that you have to grow or die. Either you're going to grow your sales and become a larger company, or else you're going to get acquired or you're going to go out of business. And so even though most companies appear in this growth box, the question we're trying to answer is, for those companies that do have sales growth, it was actually much more likely that they were building up their operating assets the year before in anticipation in this sales growth. It's much less likely, if operating assets were decreasing, that sales were going to grow the next year. In the same way, when in the rare cases that we see sales do decline in the following year, more likely than not, the balance sheet was shrinking as well. Right? There's more likely that both this year's change in OA and next year's change in sales will be negative than that you have a mismatch between the two things. So when you look at the 2 by 2 correlation of these 4 boxes, it represents a correlation of 24.96%. Looking at the second table, the only thing that we've changed is that we're now looking at growth in operating liabilities. So this means I have a larger amount of accounts payable as of the end of the year than the beginning, or my deferred revenue has grown during the year. And even though we switched to operating liabilities, the correlations look almost identical. So just like we talked about on the last slide, the same way that a buildup in inventory predicts increase in future sales, a buildup in accounts payable implies the same thing. Another thing to point out is that even though I haven't shown you the table, we can make these same 2 tables for expenses, and it turns out that growth in operating activities even more strongly predicts growth in expenses. And growth in operating liabilities is also positively correlated with growth in expenses. So at the end of the day, the answer is yes. Growth in the balance sheet, whether it's growth in the asset side or the liability side, predicts growth in the income statement, and that growth is going to be reflected in both sales and expenses. These correlations are very robust. This is pooled data for all the 20 years, but if you look at any year individually, these correlations are always positive in all 20 years of the data. There's a few other takeaways we want to keep in mind. First of all, if I run these same 4 sets of data analysis for financial assets and liabilities, the correlations are effectively 0. So if you remember our conceptual table, we had zeros in all those 4 boxes for financial assets and liabilities. The data backs that up, and they don't have implications for future growth in the operations the same way that operating assets and liabilities do. The second point on this slide is saying that, as I just pointed out, we have to look at operating assets and liabilities separately when we're thinking about growth. We don't want to net them together because, if we have large increases in both our assets and liabilities and then net them together, it will look like there's not much change going on when really the balance sheet is growing as a lot as a whole. It's just growing on both sides. And then that applies to the income statement as well. When we just are looking at growth in sales or growth in expenses, we see a strong correlation. But if we want to look at growth in earnings, we don't know which one of those is going to be larger. If both sales and expenses are growing, we don't know what will happen to the bottom line. So the implication for future earnings is ambiguous. In order to understand the implications of accruals and free cash flows on the bottom line, we have to shift our thinking from a growth forecasting perspective to a profitability or earnings forecasting perspective. And specifically, we're going to be forecasting operating income, OI. Now, to frame our thinking in this profitability perspective, you might have heard the phrase, earnings follow a random walk. Or another way of saying that is that as a rough first approximation, changes in ROA, return on assets, are unpredictable. The way that I want you to think about this is in terms of basic economics and competitive forces. So in a competitive economy, there's going to be some equilibrium level of profitability or rate of return on assets. And over time, competitive forces are going to drive all the firms in the economy to operate close to that equilibrium return on assets. Now, once you reach that equilibrium, from year to year you might have small increases or small decreases in profitability, but you're going to just be hovering around that equilibrium level, and those small changes are going to be relatively unpredictable. If we continue thinking down this path in terms of competitive forces and a competitive economy, second thing that we can learn from this is that if you see a huge increase in ROA in a certain period, it's unlikely that that increase can persist for a long period of time. Because again, competitive forces are going to come and drive away any advantage you may have had. So maybe you figured out some new innovation that led to abnormally high profitability in the short term. Then our best guess is that in the next period or the period after, you're going to have a decline back towards the equilibrium rate of return. This also applies on the downside. So if you have an extremely bad year, you're going to need to right the ship quickly, or else you're going to go out of business. And so we wouldn't expect large decreases in ROA to persist either. These competitive forces are sort of the first order effect. Now, in order to understand the role of accounting in this, we can start thinking, holding these competitive forces constant, what are potentially the second order effects? And to do that, we can decompose operating income into the accrual component, which is the change in NOA, and the free cash flow component. Now, if we want to focus on the accrual component of that, the effect of accruals on profitability is that they tend to reverse, and so in the future. And so in the current period, if we've over accrued, if we've been aggressive in recording too much operating assets, that's going to reverse in the future, perhaps in the form of increased depreciation or a future write-down, something like that. On the other hand, if we've been conservative in our accounting in the current period, that as well is likely to reverse itself in the future. So if we've overexpensed our research and development this period, then we won't see that expense in a future period when we recognize the benefits of that R&D. And so now it does make sense to net the change in operating assets and operating liabilities, because the directionality matters here, and it's the net effect, whether we have a large increase in NOA that might be, too big of an increase and so it's going to reverse out in the future, or a large decrease as well. And again, that's due to accounting conservatism and the reversing nature of accruals. So now that I've teed up why in this earnings forecasting perspective we're going to focus on the net accrual, we can step back and look at both components, the net accrual and the free cash flows, and think through their implications for changes in future earnings. As I explained, from the accrual perspective, the implication for future earnings is through the accounting conservatism or accrual reversal perspective. And you can see that the way we can write this out in terms of statistics notation is we're asking about the correlation between current changes in NOA and future changes in operating income. And when we look at this, in terms of data, we're going to scale both of these by total assets so that we can run data on a broad sample of companies, and we can compare smaller companies to bigger companies because we're going to scale every company by its size. The second question we're going to ask ourselves is, do free cash flows have implications for future earnings? And so the common wisdom in this area is that cash is king, and that the cash component of operating income, which is free cash flows, is going to be more persistent than the accrual component. And so we're going to run some data and see if that's true. Does that hold? And then we can talk about why or why not. So let's start with the accrual component, and let's look at some data similar to how we did when we were looking at the growth forecasting perspective. Now, instead of doing a strict 2x2, we did a bit more of a ranking here to sort of show degrees of accruals. And so every year we sorted companies into 5 buckets or quintiles based on their level of accruals, which is, again, the change in net operating assets. So the first quintile, the low quintile, that's the 20% of companies in that year that had the lowest change in NOA. And so for all of these companies, this was a decrease in NOA, and when we scale by total assets, the average decrease in NOA for companies in this quintile was about negative 20% of assets. And then all the way up to the largest increases in NOA. And so the companies in the highest quintile of increases, they have all increases in NOA on average around 23% of total assets. For the three buckets that were in the middle, we kind of lumped them together with one caveat. The companies that are in the middle, sometimes they have increases in NOA and sometimes they have decreases in NOA. So we said, okay, let's take everybody in the middle and just split on whether they're increasing or decreasing. And so these have much smaller increases and decreases, right? Like for companies that are in the middle buckets that are decreasing, their average decrease is 2% of total assets versus a 4% increase for the middle increasing group. Okay, so these are our four groups that we're going to look at. And then our question is, how do changes in operating income next year in the future vary across these groups? The first thing that you'll see is that in terms of, first order effect, big picture, most companies are increasing their operating earnings from year to year. And this goes back to, what we talked about before in the growth perspective, that companies have to grow or die. So the normal situation is that earnings are going to continue to grow and increase over time. But the question is, can we learn more about how much they're going to increase or the probability they're going to increase based on their accruals? And what we see is that consistent with this accrual reversal or conservatism concept is that if you had a large negative accrual in the current year, you're even more likely to recover in the following year. So you have a 70.6% chance that your operating earnings are going to increase. They're going to tick back up next year. And then that goes monotonically downwards. As your accruals increase, they're going to start leading to negative reversals in the future, and you're going to be less and less likely to have an earnings increase next year. And so by the time we get to the high accrual quintile, the probability that your operating income will increase next year goes down to only 53%. And so we can see, this monotonic decline is evidence of a clear negative correlation between your current accruals and your future changes in profitability. Let's look at the same analysis but for free cash flows. So we did the same exercise. Every year we sorted companies into quintiles based on their level of free cash flow relative to total assets. And so the lowest quintile has negative free cash flows, whereas the highest quintile has positive free cash flows. And so if free cash flows were just a cash-based measure of performance and cash is king, then we would expect to see, this same, monotonically negative decrease. But instead, we see really the changes in operating income are hovering right around that equilibrium level of 60%, and very, very slight decrease, but then it goes back up. Basically, there's no correlation between free cash flows and changes in future earnings. And the explanation for this is something that was on the last video, if you happen to watch it, the fact that negative free cash flows, it's difficult to disentangle whether that's due to poor performance or if it's due to increased investment. And so if you remember from the last video, free cash flows are cash flow from operations less the cash that was invested back into the firm. So if you see a negative free cash flow, you don't know if it's because your operations were unprofitable this period, or, and this is the more normal case, negative free cash flows usually are just because you raised outside capital in order to invest in the company. So think of these high-tech growth firms that are the darlings of the economy the last few years, like Netflix, Amazon, Apple. Netflix can have years of negative free cash flows, but have positive earnings and have, a huge stock price increase because Netflix is continuing to invest in content, in increasing subscriber count, in growth. And so as long as these are good investments, it's okay to run negative free cash flows as long as you're investing in something that will help grow in the future. And so that brings us to the notion of combining accruals and free cash flows. And so if we think again about this normal situation where oftentimes negative free cash flows are because we raised capital in order to invest, the place where we can see that investment materialize is in the change in NOA. So an increase in net operating assets, that's an investment in our operations, right? That means we put more assets on the balance sheet. We opened a factory. We increased our inventory. In order to do that, a lot of times we have to ramp up, right? We have to bring in negative free cash flows in terms of a new bank loan or raising stock in order to fund this ramp up in inventory. And so that's the most normal combination we would see, is a decrease in free cash flows accompanied by an increase in NOA. And again, thinking of that in terms of statistics concepts, that implies there's a negative correlation between changes in NOA and free cash flows. And that plays out in the data, so if we run that correlation, it's about a negative 70% correlation. One last thing that I want to point out is that while on average this negative correlation is driven by business expansion, I want to mention the second point on the slide is that this negative correlation can also play out at, towards the end of the company's life cycle when it's more mature. If you start paying out free cash flows and maybe they're liquidating free cash flows, that's going to be associated with decreases in NOA. And so, we would all love to pay our free cash flows completely out of our operating profits, but to be honest, sometimes it's going to be from liquidating our inventory, and then instead of reinvesting that inventory, we're paying out the sales proceeds back to our investors. Okay, so now we're ready to put together everything that we've learned so far. So first we talked about the fact that there's a negative correlation between this period's accrual, or change in NOA, and changes in next period's operating income. And that was driven by accounting conservatism. We tried to look at the same correlation for current free cash flows and future changes in operating income, and we found that there's essentially no correlation because by themselves we don't know whether free cash flows are driven by the operating component or the investment component of free cash flows. However, what we do know is that the investment component of free cash flows drives a negative correlation with the current period's accrual. So if we see an increase in accruals, that is an investment in the company's operations, and any time that's funded by external financing, that's going to lead to this negative correlation between the current accrual and the current free cash flow. We can combine those three key insights into what we call the benchmark accruals model. And statistically, the way that we can analyze this is using a tool called regression. Now, I'm going to assume that most of my audience is familiar with linear regression, but essentially it allows us to understand what's the conditional relationship between the accrual component and future changes in earnings, holding constant the free cash flow component, and then vice versa, the conditional relation between free cash flows and future earnings, holding constant the accrual component. And so when we put these two pieces together, incremental to one another, we expect both of these to have negative conditional associations with changes in future earnings. And again, the negative relation with free cash flows is conditional on holding constant changes in NOA because of that negative current period correlation between free cash flows and changes in NOA. And so we also expect that the main relation between the accrual component is going to be stronger than this conditional relation with free cash flows. And so we ran this regression model year over year, and we found, consistent with this framework, there was this negative coefficients on both components of earnings with a slightly larger association on accruals than free cash flows. Now, translating this a little bit into English, one way to think through this is, okay, what does it mean if I see both large increases in NOA and also positive free cash flows? Now remember, that's not the normal case. And so that means that these big increases in NOA, they're not supported by any external influx of cash. So maybe the accrual that we've recorded, maybe it's aggressive relative to whatever cash investment that was made, and that makes it even more likely that we're going to see a reversal in the future. It's more likely that there's been aggressive accounting going on when we see both positive NOA and positive free cash flows. Compare that with the normal situation where positive NOA is often accompanied by negative free cash flows. Those two effects are going to balance each other out, and we're going to be back sort of at that equilibrium perspective where earnings are a random walk and they're unpredictable. On the other side, if we see decreases in NOA and negative free cash flows, now we're at that place where the firm really does seem to be bleeding cash or performing poorly, because now those negative free cash flows, if they're associated with a decrease in our balance sheet, it's probably not that we were bringing in investment. It's probably just that our operations are losing money. Those negative free cash flows are driven by the operating component, and that is again going to be more likely to reverse or mean revert because we have to right the ship or else go out of business. So now that you understand the benchmark accruals model, we're ready to wrap up by going over everything we learned today. The starting point for this lecture was the financial statement analysis perspective, that the value of a company is primarily driven by the value of its operations. And we can set aside the way those operations were financed because financial assets and liabilities are generally already at fair value on the balance sheet, and our financing activities don't directly relate to helping us forecast growth or future earnings. It's, again, our operating activities that have implications for future growth and future profitability. And so first we said, how can we use the information in the current financial statements to forecast future growth of the company? And the key idea is that growth in the current balance sheet usually leads to growth in the income statement in the future, but that growth is on both sides of the balance sheet and both sides of the income statement. And so instead of netting assets and liabilities together, we need to look at both sides of the balance sheet separately, and to the extent they're both growing, that's going to forecast increases in both future sales and future expenses. Once we shift over to forecasting changes in earnings or changes in future profitability, now we do want to look at the net accrual, and we can decompose operating income into the net accrual and free cash flows. The net accrual, as we just went over, does help us predict future earnings because of the accrual reversal property of accounting, whereas FCF by itself is uninformative because, again, we don't know whether it's driven by operations or investment. However, we can put both of those together into the benchmark accruals model, and incremental to one another, they'll have a negative effect, but because the effect of FCF is only holding a constant whatever your accruals are, the accruals are going to take a primary role in this forecasting exercise. So I hope this has helped you organize your thinking around how to use the information in accruals and free cash flows to forecast for the future, and look forward to seeing you guys in the next video.